Kia ora, welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Frances Cook. I'm the investments editor at BusinessDesk. Now, today on the program, we're looking at the results from the latest Sharesies Quarterly Insights Survey, and of course, an update on the property market. We're joined by independent economist Tony Alexander, but before we get started, we've got some important information. Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording. All right, welcome back and welcome, Tony. Thanks so much for coming on. Always a delight.
Yeah, no, thanks for having us again, Francis. Always look forward to being here and having a look at some of the things happening in the investment and housing world, etc.
Yeah, there's a lot happening. There's a lot going on. I've got to say, I feel like there seems to be a lot of doom and gloom around, right? We're hearing about more redundancies hitting, more business failures happening. I mean, if you glance at the headlines, it feels like the economy isn't too positive right now. What's your overall read on the state of things?
Yeah, I think we're at the point where the tight monetary policy put in place by the Reserve Bank is really hitting its strides. It's having its greatest impact on the economy and therefore, with a little bit of a lag, the greatest impact on inflation. Now, the general rule of thumb is that it takes 18 to 24 months from a tightening in monetary policy until you get the inflation, responding. And although monetary policy started tightening in October 2021, they didn't start moving in 0.5% jumps until about April 2022, but they didn't get serious in terms of jumping 0.75% and warning about recession until November of 2022. So we're only, 18 months or so down the track, in fact, less than that, from the monetary policy really getting tight out there. So only now are we truly into the horrible negative impact the Reserve Bank has been wanting to see. And that's why, for the moment, they'll be hesitant about sending any easing signal when they're this close to finally getting businesses go, no, we cannot increase our prices by 5-7%. We can only manage 2%, and we'll have to look for efficiency somewhere else. And that's partly where the redundancy and et cetera are coming from. Businesses are starting to look for those savings out there.
Yeah, talk me through that a little bit more, because we hear a lot about there's this delay on when they want to cool the economy down. It takes a while to hit, as you say, that 18 months to 2 years zone. So we're hitting that now. A, why is there that lag there? And B, if there's been that lag and we've been going through this for a while, does that mean the pain continues for a while?
Yeah, the pain does continue for a while. I'd suggest all through this year, especially in most of retailing, certain parts of hospitality, and especially with residential construction, especially for the developers of multi-units. There's a whole few things we can talk about later if you like, sort of coming together there. Why doesn't monetary policy hit straight away? Well, first of all, even if people are sitting on floating mortgage rates or 6-year fixed mortgage rates, and they get hit relatively quickly with interest rates rising, they might have some savings built up. So people did build up a lot of savings during the pandemic. It was estimated in the United States pandemic savings amounted to $1.7 trillion US. Australia was running with an estimate of about 250 billion Aussie dollars. I never saw an estimate for New Zealand. I couldn't really figure one out for myself, but the feeling is in those other two countries, they've used up their savings, and I've got to assume we've reached that point as well. So that's one thing. You can have a savings buffer, which of course is what we're always advising people to have for when bad times come along. Secondly, we use fixed interest rates a lot in New Zealand. We're not all sitting on floating rates, as was the case up until about 1991. And so it takes a while before you get most people with mortgages negatively affected. And we've still got a lot of people that are yet to roll on to the high rates around 6.7, 7.2% or so. So there are these natural lags in there. And in the business sector as well, you'll have a feeling of maybe this is just a short-term thing. We don't need to make any big decisions. But what I'm saying now is I think in most business sectors, I think we do have to make some business decisions. So one of the things I'm waiting to see is not just the cutbacks on the hiring, the weakness in the labour market, which is important for slowing wages growth. When do businesses actually invest to boost productivity? Unfortunately, I'm seeing none of that as yet. Hopefully we'll see that before the end of the year.
Ooh, we'll come back to that point because that's a really interesting one. I want to jump into your latest survey because I thought what was really interesting is that despite some of this gloominess, and it is feeling terribly gloomy at times, shares investors, as a general rule, look to be picking up the pace a bit. What's happening there?
Yes, yeah, I think I was looking at the numbers earlier on, and on average, I'll have 80% of people saying, yep, I'm going to invest more in shares, ETFs, managed funds, and the most recent result was 93% there. I think partly what's going on is people have seen some good movements in some specific share prices overseas. Obviously, a lot of excitement in the technology space, NVIDIA, etc., over in the United States, development of AI. And so I think there's partly that sort of motivation there to look at the share market, but also people are still wary of maybe some other assets. I can see a long-term downward trend in people's desire to invest in commercial property, for instance. I think simply the yields, and with the high interest rates having an impact running through there. And with residential property, I can see there's an increase in the number of people looking to sell their investment properties. Despite some of the tax changes, I've only got about a net 5% or so of investors saying they're going to invest more in residential property. So that's where I have looking to buy versus looking to sell. That gap is only 5%. That's the lowest for the term that we've been running this survey. So I think in simply in terms of people having a long-term outlook and an expectation of there will be improvement. There will be an easing in monetary policy. And when it comes to assets like shares repricing every day, the incentive generally is to get yourself positioned before one day that interest rate falling induced rally comes along one day.
Yeah. And let's stick with property for a moment because I was quite interested in some of the trends you picked up there. As you say, looking a little less popular overall, and the things like the interest deductibility, which we've just seen coming through, that investors can now claim back some of the interest of their mortgage, doesn't seem to be making them feel better. So why do you think that is? Is it just that it is just so expensive as an investor right now that even things like the interest deductibility aren't working, or is it something else?
Yeah, no, I think for a lot of investors, the numbers still don't stack up in that the interest rates are high. So obviously most investors are borrowing the funds in order to invest in the property. Not all of them, but most of them. So they're hit by the high interest rates. Also, we've seen about a 30% increase in our insurance premiums for most of us, the home, contents, car insurance over the past year. So that's an extra expense. Local authority rates are going up strongly, 15, 20, 34%, etc. And there's nothing you can do about that. They have a monopoly position out there, the councils, and that is unavoidable. Also, maintenance costs that are rising over time. And also, there's a key thing. I was saying from about 15 and more months ago that when the housing market picks up, as it did in the middle of last year with buying by first home buyers, there'll be a 2 to a 2.5 year queue of delayed buyers looking to enter the market, and they'll give it extra momentum. And that was looking like some fairly flash commentary there for a while. What I didn't pay enough attention to was there's also a 2 to 2.5 year queue of sellers that's queued up as well. And they started stepping forward from July or August or so of last year. And there have been more of them appear than there have been of the buyers. People have been holding off the selling, and now they've seen the market rise, and so they're stepping forward into the market. Importantly, from a business point of view, there are many people who are looking to shore up their businesses, their small, medium-sized businesses, with equity they may have built up in their residential property investments. And that becomes relevant for when we get the bright line test period going back to 2 years. There's probably going to be a few business-owning investors who will then look to sell, won't have to pay the tax because, they'll be outside the 2-year period, but they would have been inside 10 years. And so there's probably a few extra investment properties yet to hit the market from when that 2-year changes, which I think is July 1st.
Yeah. And you also noted the difference in people's attitudes to commercial property investing versus residential, which I think is so interesting because, of course, if people are looking at things like you can invest in commercial property quite easily in many ways. You see things like the listed funds, the ETFs that are right there, and they almost never have residential in them. It's usually commercial. I would have thought that would have kept it buoyant, but it doesn't seem to be balancing it out, does it?
Yeah, no, not really. With, again, the high interest rates, this is what you always get over the interest rate cycle. As the interest rates go up, it just makes the numbers for investing in other assets relatively difficult, especially for commercial property. We've seen some high-profile funds having to suspend some withdrawals for a while. It's partly a matter of valuations going down, and so the asset backing that the banks are wanting for the debt they've taken on board, they need to do some rebalancing there. And maybe the cash flow suffering here and there if they've lost some tenants. I don't think there's necessarily a big emptying out of property as such, certainly not when it comes to industrial, warehouse storage, etc. On the retail side, well, we can all see that has challenged the storefronts in the main strip shoppings in many parts of the country. So, there'll be some weakness going through there, but often it's just usually the cash flows sort of get a little bit tight for a while there. And I think people seeing that, it's just made people a little bit wary of it. I still think commercial property demand is going to come back up again. People will look at these listed, unlisted, or direct purchase themselves if they've got the necessarily amount. But this is one of those things where we're waiting for the interest rates to go down. We're waiting to get a feel for how quickly the interest rates fall. We're waiting to get a feel for how low will they go. And none of us know this at all. New Zealand, Australia, US, UK, whatever. It's all the same. We're operating a little bit in the dark at the moment.
Yes, and I think quite deliberately from some of the central banks that they want to keep us guessing. They want to saber rattle and keep us on our toes. They don't really want to give that comfort because, of course, then inflation might bounce back up, right?
Yep, that's the key thing. Like I say, for New Zealand, we're at the point where the pressure is the greatest on the economy. Big decisions are now being made, and this is where the Reserve Bank can get the greatest payoff for the pain they've been applying starting in October of 2021, but only really hitting its strides from November of 2022. And so, they're going to keep things tight for a while. And we saw the Reserve Bank governor speaking recently and giving no hint that they are thinking about changing their projected timing for the first easing, which is about the middle of 2025. Now, like just about every other forecaster out there, I think they will ease before then. I think the first easing has a good chance of coming before the end of this year. And as justification partly for that, we saw a few days ago the monthly numbers on consumer sentiment and business confidence, employment investment intentions released by ANZ for ANZ Roy Morgan Consumer Confidence Survey. And the key one for me was consumer confidence falling right back down again. This talk of recession, the doom and gloom you were mentioning earlier on, it's put people back in their shells again. And that just reinforces that for retailers, 2024 is going to remain a pretty darn tough year.
Yeah. And we'll come back to the shares discussion in just a sec. But seeing as we're talking about interest rates and the Reserve Bank, let's stick with that for just a sec, because we've got the next OCR announcement coming up very soon. And a lot of people wondering what might happen with that, but also people looking longer term, as you say, a lot of market pundits going against what the Reserve Bank has been saying publicly, saying, no, as you say, they think it's going to happen before the end of the year. So, two things. What's your pick for the next announcement? And do you have a pick on when interest rates overall will start easing? Because I've heard guesses anywhere from August to November.
Yep. Yep. Certainly April 10, yep, so the next review coming up, I do not at all expect any easing signal from the Reserve Bank. They'll be waiting for greater information on the government's fiscal plans, the extent of fiscal tightening that is coming along. Like I say, their incentive is to hold tight for the moment because they're getting their good bang for buck in terms of business pricing decisions. There's only really just some early signs of them being reined in at the moment. And at the next review after April 10, late in May, I think then there's a little chance they may make a slightly soft comment, but I think it'll only be a really, really small one. It's just too early out there. We need to see extra weakness, unfortunately, in the labour market, extra evidence of wages growth slowing down. And of course, unfortunately, we do have these big price and cost increases going through for the likes of insurance, the local authority rates, warnings for electricity prices as well. So the inflationary thinking in people's heads isn't going to be really settling down around 2%, I think, for quite some time. My pick for the first easing is before the end of this year, but whether that's August, I think August is too soon. I think you're looking at maybe November timeline, but before then, I expect the Reserve Bank will signal an easing, and then I think we will actually start to see interest rates in the wholesale markets falling away from the second half of the year, or from the middle of the year, in anticipation of that easing, meaning I see fixed mortgage rates, which so far have come down 0.05% on this one, 0.1% on that one. I expect some slightly chunkier declines in the second half of this year in advance of that first easing.
I think you'll have some mortgage holders there hearing words like chunky declines, and you'll be making their day.
Yeah, don't get too optimistic. I mean, inflation is still at a high level. Well, we've got 4.7%, I think. The wages growth is still twice the average, consistent with low inflation out there. The ANZ survey still had a net 45% of businesses saying they're going to raise their selling prices. We need that down to the average of a net 25%. So there's a long way to go. And when I say chunky, I'm talking about not 0.05 or 0.1%, maybe a 0.2%, but something like a 1.5% total decline. It's hard to know when we're really going to get into that territory. By late 2025, first half of 2026, maybe we're in that territory.
All right, so don't get too overexcited. When we were talking about the shares earlier, I find it really interesting that people are still interested in the share market. Of course, it is one of those that is often more accessible than something like an investment property deposit. So I think that does help. But, when we're looking at what sort of investments people are still looking at, what's hot, what's not, what are people liking, what are they not?
Do you mean in terms of share market sectors or those assets like... Yeah, I don't ask specifically about the sectors of the shares. I used to, when the survey was monthly, I'd say, are you looking at technology stocks? Are you looking at agricultural related stocks, manufacturing, etc.? And what we found was basically these things never shifted. There was hardly ever any movement in where people were thinking about putting their money, the sectors that they were happy to take exposure to. And I also used to ask about your preferences for exposure to New Zealand equities, Australian and American. So basically those three is pretty much all that people would look at. They hardly ever changed either. And out of all that, I got the conclusion that people do have a long-term focus. The New Zealand share market is not remotely like it was in the 1980s, where it was just everybody became a reef fish, essentially swimming from one direction quickly to another to whatever was going to be the next big thing. That doesn't really happen in the New Zealand share market. People do have a steady long-term perspective there. Maybe that's assisted by KiwiSaver existing, and so people are taught here's long-term focus for the assets that are in KiwiSaver, and maybe that's sort of transferred across into other assets as well. And I did have a special question in the most recent survey, just a one-off one about the structure of people's portfolios. What proportion do you have in shares versus commercial property, etc. And just one thing I wanted to note on that, only 2% of people responding in the survey said they have no shares, but I had about 1/3 say they have no residential property. So when people say, everybody in New Zealand is invested in residential property, not true. not true at all. There is a high preference out there for investing in shares and that long-term focus and a bit more maybe balance over the long term as well, exposure to the economy.
Well, I've got to say, all of that is music to my ears. I love the idea that people are taking the long-term view on things because I do think, personal opinion, of course, but that does help people a lot when we hit some of these rough times. One thing that I also spotted in there, crypto, it's still small. It is still a walk on the spicy side for a lot of people, but getting more interest. What do you think's behind that?
Yeah, I think partly it's the rally in Bitcoin price over the past few months. Have been a huge increase there, and that has got people interested again in crypto. I don't know if there's much substitution of people who are looking at residential property versus crypto. I'd have to design some questions.
Might be quite different investor types.
I think there are different investor types out there. I did ask about what percentage of portfolio is in crypto there, and what have I got here? About 89% of people said they hold no crypto. And then I had about 9 people said less than 10% of their portfolio is in crypto. So that's almost 100% coverage there. So it is still very much a peripheral asset out there, but there is some slight increasing interest out there. And I did note earlier on that on average, the proportion of people saying they're looking at crypto was about 6% or so. I think we're sitting at about 7 or 9% at the moment. So, yeah, bit of an increase in interest, but people are still with that long-term focus, the steady dividends, etc., coming through. You don't tend to get dividends on crypto assets. People do still see it as toward the speculative end, especially when you consider the high volatility we've seen in prices over recent years.
It's quite interesting in this sort of market where people are seeing redundancies happen, whether or not it's happened to them. People have eyes and ears, they see it happening and they know, maybe time to batten down the hatches. And that impacts what we refer to as investor confidence, the amount people feel that they can put into the share market and leave it alone. It might not be as high, right? People might be battening down the hatches on their budgets, and sometimes changes in investment strategies has nothing to do with whether or not that investment is going well. It's how much money those investors feel like they can put aside. So how big an impact do you think that's having at the moment, and how long might that go for?
Yeah, I think clearly with the results of the most recent survey, with still a high proportion of people looking to build their assets up generally, and the especially high proportion looking at the shares, the ETFs, the managed funds, I think there's some substitution effect which is going on here. People are pulling away from some of the smaller assets and looking at an area with a long-term focus, returns doing well over the long term. We've all seen the graphs of share indexes. I think people are showing a preference there. So it would be hard to run the argument that times are so tough, people are selling their shares, cashing out, just looking to liquefy generally. In fact, the most recent survey, we did see quite a decline in the proportion of people saying they were going to be putting more money into savings accounts. And I think what we've got to remember here is that, yes, there's a lot of doom and gloom around. A lot of people are experiencing relatively hard times out there. The unemployment rate has gone from 3.2 to 4%, which is still very low by historical standards, but it is going to go higher. But only 1/3 of households in New Zealand have a mortgage. 1/3 of households are renting, and if they're not thinking about buying, then they will have a little bit of spare cash to do something with. The other third, they had a mortgage and they've paid it off, and they will be the ones who quite frankly are looking at investments generally out there, and probably less so for this older age group looking at residential property than has been the case for the past 20 years. I would suggest they maybe are showing a little bit more favoritism towards the managed funds and the long-term returns are there, given that I think some of the shine has come off residential property generally, and certainly with interest rates, when they were falling for 30 years, it naturally pushed up the prices of houses. That dynamic is not going to be there for the next 30 years. And with a lot of the baby boomers who have been into the housing market long term, or they entered it after the global financial crisis when interest rates kept surprising on the low side and people looked for an alternative asset, I don't see that effect coming along any further. So it's certainly not all doom and gloom, I think, on the investment side, and the fact that people are still showing good preference for shares sort of makes me think, New Zealand's long-term focus and not necessarily as doom and gloom as people might think, apart from the retail sector. That, I think, is really the tip of the spear of the pain in the economy.
And I do also wonder as well, of course, one of the beautiful things about the share market is it gives you access to assets all over the world, whether that is, your property funds or your typical shares or other types of funds. You can go all around the world. And do you think that there will be an impact in terms of maybe New Zealand is in the thick of businesses making hard decisions, but people can see in the US things are perking up and maybe they're thinking, okay, well, I want to get into that and I want to have a play in that happier economy.
Yeah. I think the numbers there would be relatively small. Like I say previously, when I used to ask about people's preference for America, New Zealand and Australia, the percentages just didn't change. And we saw some ups and downs, in perceptions of economies over that period of time. So I don't really think there would be many people who are actively looking at that option necessarily. All right, I'm selling out of New Zealand and I'm going to be putting a far greater proportion of my portfolio into American assets or maybe Australian. Now, having said that, we have opposition parties looking at wealth taxes. And so it would not surprise me at all as we approach the next general election, or more especially the one after that, or maybe more especially the one after that, when we feel we are due for a change, if then people show some greater attention to assets outside of New Zealand as a means, maybe, if it's technically possible, of reducing one's exposure to a wealth tax if one were to come along in New Zealand some year down the track.
Oh, interesting. I'll have to keep an eye on that one with you. I very much look forward to having a chat about that one. Look, another factor that I think we have to talk about, migration. Obviously, people coming into New Zealand, that's been pretty strong. It is a possibility that could be something that would keep inflation high and maybe delay some of these interest rate changes that we've been talking about. What do you think? What do you make of that situation and any changes we're seeing there?
Yeah, there's two forces mainly at work. There's the strong population growth, almost 3% for New Zealand last year, with a net migration gain of 134,000 people there. People who will be doing extra shopping, buying beds and all these sort of things, etc., or somebody's buying them on their behalf. So you get some extra inflation there, especially with rents. So rental growth higher than would otherwise be the case, but I can actually see some of the rental growth is slowing at the moment, and I wonder if the Reserve Bank is seeing that as well, that we're not seeing a fresh surge. I thought that might happen, but as the research and the landlords will tell you, they tend to price only to what people's incomes will bear, and people's incomes will not bear a great surge in rental pressure in New Zealand. So maybe the rental worry, the inflationary impact of migration is easing away at the moment, and of course the downward impact, the other main pressure there, is in the labour market. More people available, so we should be seeing some suppression of wages growth. Hard to find that. The wages data in New Zealand are fairly rudimentary and we only get them every 3 months with a lag, but certainly I think the Reserve Bank will be paying very close attention to the next set of numbers to see if solidly we are seeing wages growth slow down. So I do think this is one of the things with the easing in some of the rentals pressure I thought surely would naturally be there. That's one of the things which will feed into the good chance of interest rates coming down before the end of the year, supplementing the downward pressure on wages growth. We're waiting for the evidence, basically, especially on the wages growth. It's an article of faith. We think it's going to show through, but we're just waiting for the data to show it. And the Reserve Bank won't ease until they can see the data showing wages growth slowing down to a decent degree.
It is interesting on that front, on the information that we have to work with, right? Because New Zealand is operating off older data than places like Australia. Does that make it difficult to talk about these topics, and also for places like the central bank to move in a quick enough manner?
Aha, yes, good point. You see, because it takes a while for the data to come out, we have a limited number of data series in New Zealand. There is a high capacity for us to look at the data and go, oh, that's unusual. Oh, and this bit's unusual. Oh my goodness, We've actually already been in recession for 3 months and we didn't know it. We've seen that so many times in New Zealand. Oh, hang on, these things are falling more rapidly than we thought would be the case. I would suggest there is a greater potential for extra volatility and quick changes in interest rates, maybe even exchange rate in New Zealand. That would tend to be the case in other countries with more monthly than quarterly data and greater examples of the monthly data than the sparse number in New Zealand. And that feeds through to my underlying view, which is that when the Reserve Bank starts cutting interest rates, it could happen relatively quickly, that there's some catch-up easing, because we'll get the data showing through that, oh my goodness, we've been far weaker than we thought over the past few months in terms of the retail spending, in terms of other indicators out there. So it is an issue, I think, in New Zealand that we simply don't have the data, and clearly the money's not there in order to generate the data frequently enough as we see in the likes overseas. So I'm not wanting to get the borrowers optimistic, but I do have a view that we could see 1% come off the interest rates over a relatively quick period of time. The official cash rate may be starting, like I say, before the end of this year, as the Reserve Bank realises they've tightened too much. Just as they eased too much during the pandemic, I think they've probably tightened too much, and there'll be some catch-up easing. But the year's almost going to be over, I think, before we actually get into that.
Yeah, super easy to overcook when you're operating off quite old data. And as you say, I mean, we have to be realistic. The size of New Zealand, the wealth of New Zealand versus neighbours like Australia, which are much bigger and have things like the minerals boosting their economy. You just have to be realistic about what we can do, but it's a big impact, isn't it? Okay, we basically have to wrap it up. I could talk to you for ages every time this happens, but next sort of 12 months-ish, what are you expecting to happen? A high point and a low point?
Yeah, the low point is encapsulated by the mantra many business people are telling each other at the moment: survive to 25. They recognise this year is tight. This is when the cash flows really tighten up. And anyone who's been around long enough knows it's the cash flow which will send the business under, which will encourage the bank to go, nah, you're not going to make it. We're pulling the credit back, etc. So this is going to be a year of challenges for many sectors out there, but especially for retailing generally. Hospitality, which is servicing maybe a younger audience as opposed to the older people who've still got a lot of money out there to pay the mortgages off, and also the property developers in the multi-unit space. Not so much the group home standalone developers, but those that rely on the pre-sales, which they simply cannot get at the moment. And we've just received data showing that the number of properties listed for sale has risen again and is now 21% higher than in July last year. And if you're a property buyer and you're looking to make a purchase, you go, oh my goodness, look at this growing stack of properties that are already built. You're going to be looking there and less inclined to look at the pre-sales. So I think on the multi-unit property developer side, there are going to be some fairly negative stories as this year advances. But for next year, interest rates falling, good growth in tourism numbers, probably some extra growth in foreign students coming through with some of the cutbacks in Australia underway for this year. We've seen some recovery in some international prices for New Zealand's commodities, expectation of slightly stronger world growth next year, lots of infrastructure spending to be done by the government and councils over the next, century, quite frankly. These are the sort of things which contribute to next year being better than this year. I'm an optimist, so I'll probably say that most of the time, but I think there's some validity to the argument.
I know, it was so funny. I just finished an event series where I had to disclaimer the beginning of every event where I said, look, I'm optimistic, so take a grain of salt in everything I say. But I do think there are lots of reasons to be optimistic, that there's the view of light at the end of the tunnel, right? And hopefully it's not a train.
Yep, exactly. I remember learning about that in the Muldoon years in the 1970s. The light at the end of the tunnel is a train, the cartoonist told us. Well, the challenges were far worse back then, far more entrenched inflation, rigid economy, etc. And people need to remember New Zealand does have a highly adaptive economy and people as well. So there will definitely be a bounce back. Let me just make one comment. Usually the bounce back from economic recession comes from the regions and the exporting sector, and that's because tightening monetary policy would have pushed the exchange rate through the roof, and then when, oh my goodness, things are bad and the easing starts, the currency falls away sharply, and so the exporters have experienced a big lift. That's not going to happen this time around because we didn't get the currency going through the roof. We're not going to have it dropping by 20 cents on the other side as well. So I'll just put that in for those who've been around long enough and have seen previous periods of economic recovery. It's going to be more evenly spread across the likes of the household sector, the cities and the regions than has tended to be the case in the past.
Interesting. Oh, there's so many factors in the mix this time around. Thank you so much for joining us, Tony. Always a delight. And of course, thank you everyone who's tuned in. You can watch Shared Lunch on YouTube or follow the podcast on Apple, Spotify, wherever you get your podcasts. Follow us everywhere. Why not? Never miss an episode. And leave a rating and comment about what you'd like to hear next. Don't forget, we've got a special offer for Sharesies investors from BusinessDesk if you use the promo code SharedLunch2024. That's all one word, SharedLunch2024. You get $100 off an annual subscription to BusinessDesk. Hey, we're all in budget mode. Sounds good to me. The offer does only apply to new BusinessDesk subscribers, can only be used once per subscriber, can't be used with any other discounts. Enjoy the rest of your week.